Good afternoon. We're going to look at slide 2. Slide 2 takes in a period of time from January of 1995 to May of 1997. And then slide 4 will go on into a much more complicated period, 1997, 98, 99, 2000. I'm trying to just introduce basic concepts to you again. The blue line that you see, starting out at 6.4%, dipping down to about 5.2%, and then staying pretty steady at 5.4%, and then dipping, going up a little bit at the end of the period, May 28, 1997, where it goes up to about 5.8%. So the short-term interest rate declined initially, stayed pretty steady, and then increased slightly near the end of that period. What's more interesting, I think, and still open for interpretation, is the behavior of the pink line, which is talking about 10-year long-term U.S. Treasury notes. And that interest rate is very critical, again, for mortgage rates that you get through your bank. Not necessarily that the bank is holding the money, but that's the interest rate that they're going to initiate the mortgage for, usually the 30-year mortgage or the 15-year mortgage. That starts up at 7.9% at the beginning of our period, January 3rd, 1995, and then begins quite a dramatic decline from 7.9% all the way down to 5.4%. And so over that period of time, roughly second half of 1995, the two rates are actually right on top of each other. We have what is called a flat yield curve, a term I'll talk about over and over again. But a yield curve talks about a picture of what happens to short-term rates versus long-term rates. And usually it's steeply sloped upwards. Once in a blue moon, it's in the opposite direction, called an inverted yield curve. And in this case, it's a flat yield curve, mainly both interest rates are the same for a period of time. And that was a perplexing moment for the chairperson of the Federal Reserve at the time, Alan Greenspan. Alan Greenspan was appointed chairperson of the Federal Reserve in August of 1987, and that was by Ronald Reagan. He was reappointed by George H.W. Bush in 1991, reappointed again in August of 1995 by Bill Clinton. So he was already into his 12th year as we watch this story, not to 12th year, I'm sorry, 10th year, as we see this story unfold. And this period of time has been analyzed from various perspectives, and I'm not going to go into all the details, but suffice it to say that the behavior of the long-term interest rate was quite unusual, declining, and it began to have some impact on the behavior of banks at this time, because banks really couldn't make easy money because the short-term rate was roughly equal to the long-term rate for a period of time. Then, in 1996, you see it very clearly, the long-term rate retraced some of its decline and went all the way up to about 6.5%. Stayed fairly flat through 1996 and then began a descent, end of 1996, and then moved back up again in the early part of 1997. So at that time, then the banks were much more relaxed about the situation because, indeed, they could use your money or someone else's money when they would issue a CD, certificate of deposit, and that certificate of deposit might be 4 or 5%, and then they could relend the money that you were giving up or someone else was giving up at a much higher interest rate. And so that differential between the short-term rate and the long-term rate was reestablished, and banks were doing quite fine in that period. But they were worried in 1995, early 1996, about the flattening yield curve where interest rates were sitting on top of each other. Why that happened is a very complex story, and it's still open for interpretation. It wasn't the Fed that was doing that. The Fed was basically lowering short-term interest rates very slowly. But long-term rates came down quite dramatically. So what was the additional impetus? It wasn't just the Fed easing up on the credit faucet, so to speak, providing more credit to the system. It was, but at a very slow rate. It was something else happening in the long-term interest rate that actually was very good for the American economy, because at this time, lots of people were able to refinance their mortgages that they had taken out at much higher rates, and they were able to renegotiate that, might have been a 15 or 20-year mortgage, and they could renegotiate it at 5.4, 6.4, 7.4%, depending upon the risk factor, and they were able to have more money left over from their paycheck at the end of the month. So that decline in long-term interest rates was very critical for helping boost the American economy, and that surely helped Bill Clinton in his re-election campaign, because the economy was sailing along, and even though he had some problems with certain issues we won't discuss, the economy was booming, and the American populace elected him again for a second term. What I will do in my lecture, I wanted to keep this one short just to show you the phenomenon. My lecture, a little short lecture, I want to keep them short and sweet, little hors d'oeuvres, so to speak, is to go into what were some of the factors behind that decline, some of the interpretations that economists, historians, financial analysts have put forth. And it's fairly complex, so I don't want to overextend your attention span. Just recognize the fact that short-term interest rates are usually set by the Federal Reserve. Those short-term interest rates affect the interest rate that you receive at the bank for a CD, and so therefore your earnings will be affected by the short-term interest rate. And it more importantly affects what you have to pay if you want to buy a car. And in America, that's a big purchase, and most people buy their cars on a time payment plan. And this is when the time when they began to extend the number of months that you could use to pay off your car. When I bought my first car, you had it paid off in 36 months. Now I hear it's up to 72 months, which is a big difference. But of course, if interest rates are low, you don't mind stretching out that payment plan because you're really not paying that much in interest. But if you're paying 8, 9, 10% interest, as I did way back in 1975, then you want to pay that loan off very quickly, because you're just, in a sense, losing money every month you wait to pay off the car. So short-term interest rates are determined by the Federal Reserve. The long-term rate, which is the rate that we usually look at to ascertain what's happening to the housing market, what's happening to government borrowing, what it costs the government to pay for its long-term borrowing, which is a significant factor, and more importantly, what companies have to borrow at to make long-term investments. And at this time, as we'll get into, there were a lot of investments that corporations wanted to invest in. It was the internet revolution. Netscape came out with their browser, and so companies were buying computers left and right. Individuals were buying left and right. And cell phones began to become much more usable and sizable and convenient, and the prices came down. And so it was the cell phone towers that had to be built in this latter part of the 1990s. And if interest rates, long-term interest rates, coming down was a positive for that, because the corporations that were borrowing almost $1 trillion to build up the cell phone industry, they were able to do it at much, much lower interest rates, because the 10-year Treasury note rate came down from 7.9% all the way down to 5.4%. We'll end it now, and we'll go into another lecture after I take a break.